Okay, so you might have seen the latest headlines about Meta's profits and thought, wow, that looks like a complete disaster. But is it? Let's dive in and decode what's really going on with one of the world's biggest companies, because the real story might surprise you.
If you were just scrolling through the news and looked at Meta's latest earnings report, you'd probably think the company is in some serious trouble. I mean, on the surface, the numbers look pretty alarming.
Take a look at this. The big headline number, earnings per share, basically fell off a cliff. We're talking from over $6 a share all the way down to just over $1. That is a staggering year-over-year drop for a company of this scale. So, naturally, a drop like that makes you ask some pretty big questions, right? What on earth went wrong? Is the core business failing? Are users finally leaving their apps? Is this the start of some kind of downward spiral? Well, to get to the bottom of this mystery, we have to understand a fundamental concept. The official story told by the numbers doesn't always tell the whole story. We've got to pop the hood and see what's really going on with the engine. And that brings us to this really crucial idea in financial analysis, the sometimes massive difference between the official accounting rules and the underlying reality of how a business is actually performing.
You see, all public companies have to play by the same set of rules, called GAAP. And it's a good thing. It's designed to make everything consistent so you can compare apples to apples. But, and this is a big but, sometimes those very rules can paint a really weird and frankly misleading picture of what happened in one specific quarter.
Think about it like this. Let's say you had to replace the roof on your house this year, a massive one-time expense. Your official GAAP budget for that month would look terrible. It would seem like you're going broke. But your normalized budget, the one that shows your typical income and spending, would tell the real story, that your finances are actually perfectly healthy. What we need to do now is find Meta's new roof. So, let's go on a hunt. Let's dig through the financial statements and find that one-time item that's throwing this whole picture out of whack. And boom, here it is, buried deep in Note 11 of their official filing. The culprit isn't a business failure at all. It's something called a discrete charge, which is basically just accounting speak for a one-off item. And it's all related to a new piece of U.S. tax law.
Just let that number sink in. We're talking about a nearly $16 billion charge. But, and this is the most important part, this isn't cash that the business lost because of bad sales or anything like that. It is a one-time accounting adjustment they were required to make.
So that shocking earnings drop we saw at the very beginning, this is it. This is the whole reason. It's not a problem with the business itself. It's almost entirely due to this single, massive, one-and-done accounting event. Okay, so now that we've found the new roof and we understand what it is, let's set it aside for a moment. Let's look at the actual health of the core business underneath all that accounting noise, because this tells a completely different story.
First things first, the foundation. Are people still using their apps? Absolutely. The number of daily active people is still climbing steadily, now reaching over 3.5 billion people worldwide. The engagement is clearly still there, and it's growing. Now this is where it gets really interesting. For a business like Meta, revenue growth comes from two key things: showing more ads and charging more for each ad. And what do we see here? They are crushing it on both fronts. Ad impressions are up 14%, and the average price they get for each ad is up 10%. That is a textbook definition of a healthy, thriving advertising business.
So let's just put this all together. The user base is growing. They're showing more ads to that growing base, and they're charging more for those ads. A huge driver behind this is their AI, especially tools like Advantage Plus, which has already become a $60 billion a year machine. The fundamental engine is absolutely firing on all cylinders.
So, if the core business is actually this strong, what could their earnings look like once that giant $16 billion charge is in the rearview mirror? Well, this is where we can start to see the potential for what some are calling an earnings breakout.
And we can actually build a pretty simple model to project what that earnings explosion could look like by 2027. It really just comes down to 3 steps, using analyst estimates and the company's own plans.
All right, let's walk through the math here. First, revenue. If you assume it keeps growing at about 16 to 18% a year, which is what analysts expect, you get to around $260 billion. Next, profit margins. As AI makes things more efficient, those could expand to over 45%. That gives you an operating income of about $117 billion. And now for the kicker, share buybacks. The company is buying back over $40 billion of its own stock every year, which means the profit gets divided by fewer shares. When you run all those numbers, you get a potential EPS of over $35, maybe even pushing 41. That is a world away from that $1 headline number.
So, after all of that, what's the big takeaway? What does it all mean when the official story and the underlying reality seem to be telling two completely different tales?
Well, it shows why it's so important to look beyond the scary headlines. In this case, that ugly GAAP number is effectively masking what seems to be a fundamentally healthy, growing business with some truly massive future earnings potential just a couple of years down the line. Which leaves us with one last thought to chew on. When a big, messy, one-time accounting event creates a negative headline, does it also create a value discovery opportunity for anyone willing to dig just a little bit deeper and see what's hiding in plain sight?